Let's start chapter 17. Chapter 17. The name of chapter is fraud, fraudulent behavior, and their prevention in business. In this chapter, we will learn about what is a fraud, how fraud can happen in the organization, and how organization can prevent fraud in the business, in how fraud can be stopped in the business. What is the difference between error and fraud? What is the difference between error and fraud?
Intentional.
Error is unintentional. Unintentional.
Yes, fraud you're doing with purpose.
Unintentional misstatement in the financial statement, we can say this is error. An intentional misstatement. Intentional misstatement in the financial statement will be called fraud. So the meaning of fraud. Fraud is an intentional act involving the use of deception or obtain an unjust or illegal advantage. To gain any advantage, not in legal way, illegal way, the intentional act to gain that illegal advantage is called fraud. Essentially, theft by deception. Fraud is criminal offense punishable by a fine or imprisonment, especially in the UK. What is error? Unintentional mistake. Error is an inevitable part of human nature. I mean, it could happen. So system of internal checks are essential in order to prevent or detect any possible errors. Through internal control system, errors can be prevented and detected. What are irregularities? Is something contrary to a particular rule or standards. If anything is not going according to standards, according to rules, we will call it irregularity. What is misstatement? Is something stated wrongly. This can arise due to fraud, irregularity, or due to error. In financial statement, misstatement could arise either due to fraud, unintentional misstatement, due to fraud intentional, due to error unintentional, or not following the accounting standard mean irregularity. Meaning not preparing financial statements as per accounting standard, that will be called irregularity. As far as the financial statements are concerned, fraud comprises both the use of deception to obtain an unjust or illegal financial advantage and intentional misrepresentation affecting the financial statement. Means sometimes company management bonuses are aligned with profit achievement. Like if the company will achieve a certain profit, then managers will receive their bonus. If that certain process of profit is not achieved, what they will do, they will manipulate the results. They will overstate the income. They will understate the expenses so that the target profit can be achieved to get their bonus. So these kind of misstatement in financial statements are called fraud. So how fraud has occurred? Deliberate falsification of documents record. If company is not generating enough sale, what management will do? They create fictitious sale. They create fictitious sale document to highlight profit to get their bonus. Deliberate ignoring of errors requiring a correction. Management know there are some errors in the financial statements, but after correcting those errors, might be the financial results will become poor. So they keep those errors as it is, don't want to correct them. This is also called fraud. And deliberate suppression of relevant information, like if they do not provide information to relevant person on time, due to that might be there are chances of hiding the things. So these are also come under fraud. Where fraud is easy, I mean, if there are characteristics of organization like these three, the fraud is easier for the employer. Dishonesty. If in organization people are dishonest, they don't focus on integrity, there are high chances of fraud. Opportunities. Like if company internal control system is weak, policy procedures are not properly followed by nobody monitoring the internal control system, there are high chances of fraud. And motivation, where employees, managers are having motivation, like their salaries are based on meeting targets. There is no fixed element in their salary. So there are high chances of a fraud because to get the high bonus, they need to show high results. And to show high results, they do not follow standards, they create fictitious transactions. So these are the three prerequisites of a fraud. I mean, these are the three situations in the organization where high chances of fraud. Dishonesty relate to lack of integrity or honesty. An honest employee will be unlikely to commit a fraud. Opportunity, the individual must have the opportunity or opening for a fraud to the committed. The opportunities will often be created due to weak internal control system. And motivation, the individual must feel that the reward that can be earned by the fraud will outweigh the potential cost if they are caught. If people who are committing fraud, anybody catch them and there is no action from the management against those people, this means management providing motivation to the employee, whatever you want to do, we will not take any action. So there will be high chances of fraud if management is not taking action against any person who have caught committed fraud. All three usually required. For example, an honest employee is unlikely to commit a fraud even if given the opportunity and motive. Factors that might indicate increased risk of a fraud errors include there are some factors due to which there will be high chances of fraud in the company. Management domination by one person. If one person dominating the whole management, mean one person is having all the power, this means there is nobody to question him. So there will always be high chances of fraud in the organization. That's why responsibilities should be divided into different people. No one person should be responsible for all the functions. Unnecessarily complex corporate structure. If organization structure is complex means business is having so many subsidiaries, business is having so many branches, so many associates, then management can easily make fraud in the financial statements because the fraud will not be highlighted through complex structure. Frauds can be covered through complex structure of the organization because first you need to understand the structure. First, you need to understand the corporate structure, the complexities, then you can identify the fraud. Poor staff morale, where relationship between management and employees are poor. So what employee will do? They will motivate you towards a fraud. They will try to steal company assets, try to misuse company assets, and stealing, misusing company assets is also comes under fraud. Personnel who do not take leave holiday. Personnel who do not take leave holiday mean according to HR record, if any person haven't taken any of the holiday in past 1 to 3 years, which is unrealistic. This means there is a chance of fraud might be on the day he is not on working, somebody is recording his hours, somebody recording his present. Lavish lifestyle of employees. Lavish lifestyle of employees mean an employee coming in Rolls Royce and his salary is a 5,000 dirham. So from 5,000 dirham salary, he cannot afford Rolls Royce. This means there are chances he is committing some kind of fraud in the organization, and through that fraudulent money, he is enjoying this lavish car. Inadequate segregation of duty. What is meant by segregation of duty? Segregation of duty. Division of work. To stop fraud, you need to divide the work into different people. Because if one body is committing something wrong, the other person can highlight this. If there is no segregation of duty, in no division of work between different people, one person is wholly solely responsible for all the tasks. So there are high chances of a fraud. Lack of monitoring of control system. If control system is not monitored, this means fraud errors will not be prevented, detected, corrected. So there will be high chances of fraud. Unusual transactions. What is meant by unusual transactions? If suppose company policy is to sell sell goods on credit only, but if there are some cash sales items, this means these are unusual transactions. These could be due to fraud. Payments for services disproportionate to effort. I mean, if some employee working too hard, but you are not paying them that much amount against his efforts, so what he will do, he will be demotivated. He will try to do fraud. He will try to steal company assets, misuse company assets because he is putting so much effort, but you are not paying them enough against their efforts. So they will misuse the asset when there are chances of fraud in the organization. I mean, these are the indicators of fraud. I mean, where chances of frauds will be higher, where management is dominated by one person, where business organization structure is complex, staff morale is low, persons haven't recorded any holiday in past 2 3 years, lavish lifestyle of employees not matching with their pay or level, control system is poor, inadequate segregation of duty, unusual transaction mean transactions recorded from away of normal routine of the business. Like normal routine of the business is customer take either 5 to 10 goods maximum. But if there are any transactions of 50 or 100 goods, this means these could be created due to fraud. Example of fraud in a business mean how many types of fraud in a business. Frauds can happen at management level or at employee level. Normally at management level, fraud are relating to misstatement in financial statement. While employee level fraud are relating to misuse of business assets. So fraud can happen at two levels in the organization, at management level, and management level fraud are normally relating to misstatement in financial statement at employee level, and these are relating to misuse of assets. So fraud can be carried out by managers, employees, or third party of an organization in question. By management, financial statements fraud, window dressing. Window dressing means misstatement in the financial statement. And cooking the books mean preparing false reports. Misappropriation of assets. They can also misuse of assets. False insurance claims using the company's asset for personal use. What could be the frauds at employee level? Sales ledger fraud, teaming and letting. What is teaming and letting? Teaming and letting means suppose company made a sale, credit sale to one customer per 100,000. This means they have recorded receivable debit and sales credit. Then they recorded another sale with another customer. Then they recorded another sale with another customer. Mean companies having 300,000 sales recorded. This customer, first customer paid the money to the company. The employee who is managing this receivable sales ledger, he kept that money into his pocket, 100,000. Next customer paid the money. He recorded as adjustment to this customer. Next customer paid the money. He recorded as adjustment to this customer. Next customer paid the money. He recorded as adjustment to this customer. Mean like this, he is enjoying 100,000 from the company account. This is called teaming and letting. Mean when you are adjusting next customer receipt with previous customer receipt, and then next to previous, then next to previous, mean you have enjoyed the previous receipt in your pocket. This is called teaming and letting. This can be traced if you move staff from one place to another. Like the person working on sales should be moved towards purchase system, and purchase system person should be moved to sales system. Then the new person will highlight this issue. If one person is continuously working on one area, then there are chances of teaming and letting. So what could be the employee level fraud? Sale ledger fraud like teaming and letting, stealing a cash sales, checks received, purchase ledger fraud, and skimming scheme payroll fraud. What is this scheme? Skimming scheme mean stealing company inventory and then removing from the records. The records will show lower level of inventory. Obviously, physical inventory is also lower because the removed inventory has been taken out by the employee. There could be some fraud by third party, like false billing fraud, especially through purchase department. Like organization has purchased any goods for 100,000, but this purchase manager asked the supplier, please send a bill of 120,000. 20,000 I will take from you afterward. These could be the fraud with the third parties that employee normally do. So example, fraud by third parties, false billing fraud, bank account fraud, advance fee fraud, and Ponzi schemes fraud. Ponzi scheme. What is Ponzi schemes? It's financial fraud. Nowadays, some organization have started like if you invest some money into our business, we will provide you a high return on that investment. How they provide the high return? They are creating more and more investor under one investor, mean chain of investor under one main investor, and the money took from those under people will be paying to the higher people in the chain. This is called Ponzi scheme fraud. Like one person have made investment in the business. There are two persons working under it. They provided the money. They refer to other people. They provided the money, and they are providing each other people at lower the money to the higher people and to the higher people. And the first money is kept by the organization itself. So these are the three examples of fraud: frauds by management, fraud by employee, or fraud by third parties. So normally management do a fraud of fraudulent financial reporting mean misstatement in the financial statement. Not 95% management level frauds are relating to fraudulent financial reporting fraud. What is fraudulent financial reporting fraud? Deliberate misstatement, intentional misstatement in the financial statement. Why management misstate the financial statement? Why management will misstate the financial statements? Why they create this kind of fraud? To gain bonus. They misstate the financial statement. Or due to pressure of other parties. Like shareholder pressure is that if next year profit will not grow by 10%, I will withdraw my investment. And that shareholder is a major shareholder. Obviously, if he will withdraw his investment, the business will collapse. If suppose the profit has not grown by 10%, what management will do? They will create some kind of misstatement to show growth of profit by 10%. Sometimes other party target of other parties like bank have provided loan to the company, and he said that if your company asset fall below 1 million, I will call back my loan. This means we need to maintain our asset at 1 million. If it's fall below 1 million, we need to pay the loan amount back to the bank. Might be we are struggling. We are not able to pay back, cash back to the loan. So if suppose the assets are below 1 million, what the management will do? They try to create fictitious assets so that they can show 1 million asset in the balance sheet. This is called fraudulent financial reporting fraud. So normally management fraud are relating to fraudulent financial reporting, mean misstatement in the financial statement. What could be the reason? These could be the reasons. Examples of fraudulent financial reporting include, mean what they do, recording fictitious entries in the accounting records, mean recording fictitious sale that has not actually been occurred, particularly those close to the accounting year end, that is called window dressing. Inappropriately adjusting assumptions and judgment used to estimate account balances. In some account balances, there are certain figures that are based on management estimate judgment. Have you heard about the term depreciation? Whether company need to depreciate asset on 10% or 20%, it is estimates of company management. They will decide. Obviously, by depreciating asset 20%, the depreciation expense will be more. By depreciating asset by 10%, the depreciation expense will be lesser. If suppose they want to highlight current year profit, what they will do? They will change the depreciation rate to 20% to 10%. Maybe instead of 20%, they will change to 10% so that less expenditure will be recorded, and this will result into high profit in the organization. This is called inappropriately adjustment assumptions and judgment used to estimate account balances. Omitting, advancing, or delaying recognition in the financial statement of transactions that have occurred during the year. And to show good results, they sometimes omit some kind of transaction like expenses. Advance or delaying recognition mean not recording transaction in current period, they delaying to record in next period so that current year effect cannot be shown. Like expenses of current year, they will record in next year so that current year profit can be shown higher. Concealing effects that could affect the amounts recorded in the financial statements mean not providing some kind of disclosures in the financial statements, that is also called fraudulent financial reporting fraud. Altering records relating to significant and unusual transactions mean changing the records to show favorable results in the financial statements, that is also called fraudulent financial reporting fraud. In daily language, such schemes can be referred to as cooking the books, mean preparing false books, false records. Other descriptions are creative accounting and earnings management. All these schemes may or may not comply with the level of standards accounting rules, but they are usually contrary to the spirit of this. Mean all these terms are used for fraudulent financial reporting fraud. What are the terms? Cooking the books, creative accounting, earning management, or window dressing. Ultimately, it is up to the court to decide whether a particular scheme is fraudulent, but hopeful the external auditor will have persuaded by the directors of a company against a fraudulent scheme long before it gets to court. Example of creative accounting. What is creative accounting? Window dressing is called creative accounting. Delaying or accelerating a company's expenses mean not recording a current year's expenses in current year, delaying so that they should be recorded in next year. Because if we not record the current year expense in current year, profit will be higher. Inaccurate revaluation of company's asset. What is revaluation? You will study in F3, financial accounting. Manipulation of revenue recognition mean next year revenue they are recording in current year so that revenue profit could be higher. And off balance sheet accounting. Off balance sheet mean not disclosing, not showing some of the liabilities in current year balance sheet. That is called off balance sheet accounting. These are all terms relating to accounting knowledge. Like examiner is assuming you are studying financial accounting along with this paper. There's another topic called money laundering. What is money laundering? What is money laundering? It is a process of converting. It is a process of converting black money to white money. Black money means the money generated through illegal sources mean illegal money. So white money mean legal money. So the process to convert black money into white money is called money laundering. If it is a process, this process involves 3 stages. What are the 3 stages? Placing, layering, and integration. Placing, layering, and integration. Placing means putting illegal money into a legal business. Putting or investing the illegal money, black money into a legal business is called placing. Layering means performing transaction. And so many transactions so that the true origin where that money have been generated can be hidden. So performing transaction to hide true origin of the money mean where that money was generated, especially through foreign transaction. Through foreign transaction, you can hide the true origin of money easily. Because if one country is receiving money from any other country, they will not bother where from this money is coming. They are happy that money is coming into our country. Suppose you have generated illegal money in one country and you have transferred to another country. So another country doesn't bother where this money coming from, what's the source of money. And then you call back that money from other country to your country. This means your country will not be bothered to ask where this money coming from. They will be happy money is coming into our country. So through this, you have hide the true origin of your illegal money. So there are 3 stages: placing, putting, investing illegal money into legal business; layering, performing transaction to hide the true origin of the money; and then integration. Integration means to withdraw that money from the business and use like a legal money. because that black money has converted into white through business investment, business transactions, and then withdraw from the business. So what is money laundering? Money laundering is the exchange of dirty money, mean illegal money and assets that have been criminally obtained illegally for clean money, mean white money and assets that have no clear link to criminal activities. While the term money is used, in reality, this can refer to any criminally obtained property, including cash, securities, and intangible assets. Typical money laundering legislation recognizes three main offenses relating to money laundering. Every country have defined laws relating to money laundering. And all the laws of money laundering are focusing on three main issues: laundering, failure to report, and tipping off. What is laundering? Laundering is a process of converting black money to white money by performing transaction in legal business. That is will be called laundering. Failure to report, like if you are working in any organization as at whatever role, if you have find somebody is involved in money laundering, it is your responsibility. You have to report to the legal bodies, regulatory bodies. If you are not reporting, you will also be involved in money laundering. You will also be considered to be involved in money laundering. And for that, you might be facing fines as well as imprisonment up to 5 years. Like if after qualifying ACCA, you are working as an accountant, as an auditor in any organization, and during work you have found that some person is involved in money laundering, it's your duty, you have to report to the legal body. If you are not reporting, you will face imprisonment or fines from the legal body. The imprisonment could be up to 5 years. What is tipping off? Tipping off means providing wrong information. Providing wrong information or to hold true information. Like while auditing a client company, we have discovered that client company management is involved in money laundering. If you have identified client company management is involved in money laundering, what you need to do, you need to inform the regulatory body, legal bodies. But if instead of reporting to legal body, you started a discussion with the client management, oh, we have come to know that your people are involved in money laundering. This means you have given them the chance, like you are aware of it so that they can hide. And you have given them the chance, they should also involve yourself into the money laundering by providing you some kind of benefit. So this is called tipping off, mean providing wrong information or holding true information, mean where you are required by law to provide information regarding money laundering to the legal body and you are not providing, this will be called tipping off, and tipping off is also a criminal act. So tipping off, disclosing of information which may prejudice a money laundering investigation carries a minimum 2-year imprisonment then. So what is money laundering? Converting black money into white. The process will be called money laundering. And there are three types of money laundering: laundering, failure to report, and tipping off. Money laundering itself normally falls three distinct phases. What are those three phases? Placing, layering, and integration. What is placing? This refer to the placing of illegally obtained cash or assets into a legitimate business, mean investing, putting illegal money into legal business. Layering, this relate to the transfer of money between our location in order to conceal their original source, to hide their original source, performing transaction, especially foreign transaction, i.e. in a right, uh, i.e. in wiring money between banks to make its original source harder to trace. Integration after layering, the money now appears to have come from a legitimate source. So to withdraw that money from the business and use like a legitimate legal money, this is a process of money laundering completed. The controls and procedures required by law will often include what a company should do regarding avoiding money laundering and fraud, identification of large or unusual transactions. If there are any transaction in the organization that is of huge amount, big amount, you should review them because there could be chances of fraud or money laundering. Scrutinizing of unusual patterns of transactions. If transactions are not performed as per regular pattern, then you need to investigate it because there could be chances of money laundering or fraud. Taking steps to ensure all customers can be identified. You should always ensure that all your customers actually exist, and where they exist, you should have a knowledge about them. Otherwise, management can create fictitious customer to create fictitious sales. Creation of the role of money laundering reporting officer means every company should have a person as MLRO. What is his responsibility? His responsibility is to provide awareness to the staff regarding money laundering. And if there is any chance of money laundering in the organization, he need to report to the regulatory body. Undertaking appropriate customer due diligence means while creating contract with any of the party, you need to ensure due diligence. Due diligence means his honesty, his integrity. If that customer, that party is honest, high integrity, then you should create contract with them. If other party is dishonest, not focusing on integrity, try to avoid those parties. Otherwise, they will provide their characteristics on your personality. They will involve yourself into making fraud like they are doing. So try to avoid wrong people. Otherwise, you will also be interested in doing things that they are doing. So these are the steps, these are the procedures that organization should need to follow to avoid money laundering. When establishing a new business relationship, we need to check whether the person is honest, whether the person integrity is high, there is no bad repute of that person. When dealing with the occasional transaction or more, not carrying out within normal ongoing business relationship, this indicates identifying a linked transaction. Don't need to cover this. When money laundering of the financial terrorism is suspected, you need to report to the legal body. When the organization has doubts about the accuracy of the identification of information it has previously obtained from the customer, this means there are chances of frauds. And when a customer circumstances change, you need to make sure whether companies are recording transaction with the customers are fake customers. It is also important that a business has a defined reporting process for suspected money laundering. Mean employees should be aware of when they can find money laundering to whom they should report. Obviously, they should report to their senior person in the organization, and the senior person should report to any regulatory or legal body. And this will involve employee reporting suspicion to MLRO. Every company should have appointed a person called MLRO. The MLRO investigating further. And if you have found any money laundering in the business, you need to report to MLRO. MLRO will see whether it is a money laundering or just a suspicion. If there are grounds for reasonable suspicion, the MLRO should report to the relevant authorities. In the UK, this would be serious organizational crime agency, in the organization available in UK to whom we should report money laundering offences. The name of that organization is a SOCA, Serious Organized Crime Agency. For every business, what they need to do regarding money laundering, they need to appoint a person MLRO in their organization. If there is any indication of money laundering, the employee should report to MLRO, and then MLRO should report to SOCA in UK. SOCA stands for Serious Organized Crime Agency. Okay, moving towards next topic, the possible implication of a fraud to the company. Mean if there are fraud in the business, what could be the implication? There is a spectrum of implication of fraud from immaterial to the critical, including loss of shareholder confidence. In case of fraud, shareholder will lose confidence into the organization. They will try to withdraw their investment. Loss of assets, company asset value will go down because shareholder withdrawing their amount, so asset will be having no value. Financial difficulties, might be companies facing financial difficulties because the money has been used into wrong hands. Collapse of the company might be collapsed because nobody will try to have contact with the fraudulent company. And fines by tax and other authorities mean company need to face fine from taxation department or from other authorities. Measure to prevent and detect a fraud mean what management can do to prevent and detect fraud. Control environment mean top level management attitude should be positive regarding policies, procedures regarding fraud errors. If they are not showing positive attitude, then employee will not be willing to avoid fraud. Risk assessment process mean every month organization should perform risk assessment, mean there are any chances of risk, try to control them. Because if you are not controlling those risks, there will be chances of frauds. Your information system should be quick. Communication system should be quick so that if there is anything going wrong, you can communicate to appropriate authority on timely basis, and timely basis action can stop those irregularities. If information communication system is slow, then the reports of wrongdoings will not be made on time. On time action will not be taken from the management. So fraud will be bigger. Control activities mean organization need to implement control activities. What are the control activities we have learned in this yesterday lectures? Segregation of duty should be there, supervision should be there, thematic check should be there. And monitoring of control means company need to arrange internal auditor who should monitor the internal control system, who should monitor the happening of a fraud in the organization and highlight it. If there is no monitoring, there is no control system, meaning no policy procedures, everybody will be motivated towards conducting fraud. The duties of management in preventing and detecting fraud. What are the duties of management in preventing and detecting fraud? It is the main responsibility of company management that they should implement policies, procedures to prevent and detect fraud. Nobody else in the world. So the duty of the board of director to maintain a sound internal control system. The duty of audit committee to monitor and review internal control and risk. And the duty of employees generally, including a senior employee below board level, will indicate hard fraud prevention and detection. So who is responsible for preventing detecting fraud? Board of directors as a whole, audit committee, employees as well. Question number 1, please. Which of the following is not a necessary requisite for fraud? There were three requisites. A deliberate act, collusion between two peoples, deception, aiming to gain as a result of fraud. Deception was there. Aiming to gain as a result of the fraud was there. A deliberate act, mean intentional act, is a fraud. So it is not prerequisite collusion between two or more people. Because one person can make fraud, it's not like only 2% can make fraud. So B option is not. Question number 2. Which option suggests an increased risk of fraud and error when recording transaction? Which option suggests an increased risk of fraud and error when recording transaction? Simple corporate structure? No. In case of complex corporate structure, there are high chances of fraud. Employee who take regular holidays? No. If employee do not take regular holidays. High staff morale? No. In case of low staff morale, there are high chances of fraud. Employee bonus based on sales achieved? Yes. So which option suggests an increased risk of fraud? So which option? D option. Number 3, why would auditors estimate large credit notes? Credit notes mean sale return. What management normally do? To highlight profit, they record fictitious sale at near to year end, so that financial statements can be prepared with high sales, high profit, and after the year end, they record sale returns. Through this, the sale effect will be eliminated, but in next year, not in current year. Because if they have recorded sales, they have to show the cash. So for fictitious sale recorded at year end, what do? They record sale return after the year end. So why would auditor examine large sale return issued at the start of the financial year, means relating to previous year sale? They may suggest non-current assets are being stolen. No, it's not relating to non-current assets. They may suggest window dressing of sale. Yes. They may suggest cash is being stolen. No. They may suggest purchase are being misstated. No. So correct option is, why would auditor examine large credit notes issued at the time of the officially be window dressing of sale? Number 4. Which of the following controls would discourage a teaming and letting fraud from occurring in the payments received impairment department? Two people should be present at the opening of mail. Records are made when mail continuing monies is opened. Regular rotation of duties in the department. Control account reconciliation should be performed each month. Through rotation of staff, you can identify if one person was recording a next receivable against previous receivables, the new person can highlight those issues by matching the records. Number 5. Which of the following would not be an offense under typical money laundering legislation? Possessing stolen property. Possessing stolen property. Obviously, if you are possessing stolen mean illegally. Investing the proceed of the sale of stolen goods. This is money laundering. Theft of cash and other assets. Transferring stolen property. Which of the following would not be an offense under typical money laundering legislation? Which is not. Theft of cash and other net assets, this is not money laundering. It's not converting illegal money into legal. Number six, laundering refers to the transfer of money between business or location in order to conceal their original source. I mean, hide their original source. Is this statement true or false? Money laundering mean transferring of money between businesses or location in order to hide their original. Yes, it's really it's true. I'm leaving now because I'm not feeling well. I had medicine and I'm not concentrating on teaching now. I'm feeling sleepy because I had free medicine.
Yeah, I used to take it.
So probably we will be having two more classes in this week.
Oh,
So
sir,
next, sorry,
when will be the other two classes, sir?
when will be the other two classes? Good question. Probably on Thursday and Friday.
For me, it's